Welcome to the How Did They Do It Real Estate Podcast. Have you ever wondered how people succeed in real estate and what steps they took to get there? If so, this podcast is for you. Your hosts, Sayla and Eileen Prack, interview top experts in the real estate community to share with you their real estate journey and how they achieved massive success. Our goal is to provide you with valuable real estate resources and to help you apply it to your own real estate goal. Welcome to today's episode of the How Did They Do It Real Estate Podcast. I'm your host, Eileen Prack. And today our guest is Jered Sturm. And he is a multifamily owner, operator, and syndicator focused on the Cincinnati, Ohio market. And currently he is the Chief Executive Officer of S&S Capital. So we're super excited to have an expert in the Ohio market sharing a little bit about what he does in the space, what he's seeing in the multifamily arena over in Cincinnati. So Jered, welcome to the show. How are you doing today?
I'm doing great. Thank you so much for having me and for the audience to listen to my story. I appreciate the platform that you've put together that gives me the opportunity to share with them.
Thank you so much, Jered. So if you can start off by sharing a little bit more about your background and how you got started with real estate.
Yeah, I think how I got started is a story that resonates with a lot of people because it's very organic and repeatable. And so I actually started in the industry as a maintenance tech myself. So I was the guy fixing the toilets, hanging the blinds, doing those things. I did that in high school and worked for a great guy, but learned a lot of what not to do as a business owner. And then ultimately started my own construction company with my brother, where we did kitchens, bathrooms, additions for homeowners, and used those skill sets and started buying real estate in 2008. So it's been about 15 years. When we started, it was single family houses. And then that grew from single family houses to fourplexes to 10plexes to ultimately now what we're buying today is 100 plus unit apartment communities in Cincinnati, Ohio, but always focused on the construction background and adding value through construction and property management.
How did you make that shift from actively doing the work within real estate, building up, doing the maintenance, construction aspect of it, to turning around and to becoming a real estate investor, purchasing the apartment buildings and turning that into more of an investment?
It was a slow shift. So it wasn't like a light switch flipped and all of a sudden it was one or the other. For the first 4 or 5 years, it was myself and my brother. We would go do a high-end kitchen or a bathroom or an addition on a home during the business hours, right? And we would then use the funds that we made in profit from doing those renovations. And then we would go buy a little single-family house, and on nights and weekends, we would be there doing the renovations to that and substituting our lack of capital at the time with sweat equity. And just slowly but surely accumulated. And I'll even highlight of my story that was in 2008, 9, 10, 11. And so this was a time where lenders were not lending, and they certainly weren't lending to 18 and 20-year-olds who didn't have W-2 jobs. And so our first 8 investment properties had to be acquired and renovated 100% cash. And so that was a big barrier to entry that we kind of had to just chip away at. And it took years to do it. But after we bought, renovated, and stabilized 8 assets, we did find a little local lender that did a cash out refinance and put a portfolio loan on our 8 properties. And I'll never forget that day because it was like, oh my gosh, this works, because it was a substantially sized check for us at the time. But the wise decision we made, even though we were in our early 20s at that time, was to take that check and buy 10 more properties rather than, go buy some extravagant car or something like that.
So the 8 homes that you had purchased all in cash, that was just based off of the sweat equity that you had worked doing the construction, maintenance, and hard-earned money that you and your brother were working towards.
Yes. And one of the advantages of starting very young is you also have a lot less overhead and responsibilities. And so it does take delayed gratification and self-discipline to not go spend that money. But we were pretty good at the construction stuff. So we could do a kitchen or a bathroom and make, 20, 30 grand on it. And it was the discipline that had to say, okay, we're not going to just go spend that on something, but we're going to reinvest it into another rental property. And so that took a lot of self-control, but that's what we decided to do. But yes, the first 8 were all just earned income through construction.
What do you think attributed to that discipline that you had in order to continue investing those earnings that you made instead of living the life, especially as a young person in this country?
I don't know. I mean, me and my brother had a great upbringing, very disciplined parents, but neither of them were entrepreneurial. And so I've had this question before, like, why do you think you have gotten to where you're at right now? And the best answer I can give is I was not a good academic student. And so the traditional route of high school, college, corporate job, climb the ladder just never, ever stood out to me. And so it was always about finding an alternative that would work. And so I was looking for those alternatives, and the dominoes fell that led us to this solution. But I've always said it's a gift and a curse, but I'm very good at forward thinking. So I'm good at thinking 10 years down the road. And sometimes why I say it's a gift and a curse, it's a gift within business, but sometimes it can be a curse within personal life because you're not as present in the current moment because you're always looking ahead at the next thing. And so maybe it's just a natural aptitude to be able to do that. I'm not really sure.
So after those 8 houses that you had bought, then you refinanced it, and then you took that proceeds and you put it into another 10 properties. Was that another 10 single family homes, or was it a multifamily, or was it consisted and broken up of a couple different properties?
I think it was 10 more single family homes. We got up to about 70 single family homes, and then we were buying 4plexes and 10plexes, and we liked scaling. We liked buying larger properties. And then ultimately we were generating a decent amount of cash off our rentals and still doing a little bit of the construction. And we had enough money to go buy a large apartment community, which then we saw the operational efficiencies of that and the ability to build systems and processes around this specific property. We said, okay, this is what we want to do. And so for a very long time, I would say 7-8 years, we had our portfolio of smaller assets, and then we were buying larger apartments. But then in 2020, we made the decision that we wanted to focus exclusively on larger assets. And so we sold all of our smaller assets and just focused on buying large apartment communities. But to continuously buy large apartment communities, we also ventured into the syndication model. So raising money from limited partners who participate in the ownership with us and allow us to buy larger and larger communities and benefit from those economies of scale that we talked about.
So was there any, I guess, challenges or hurdles that you had to overcome when you decided to go full force into multifamily, selling all the single families and converting that all into multifamily properties?
Well, it wasn't like we didn't sell all the single families to then go into multifamily. There was many years where we were holding both portfolios of single families and the multi, but it felt like we were running 2 businesses operationally. One was scattered site, but the biggest hurdle or barrier to entry was capital. To buy 200 unit apartment community, you're talking about somewhere between $15-20 million. That's a lot of money. And so being able to make that happen is a challenge. But we have been able to figure it out through partnering with limited partners on the equity side, building good relationships with debt lenders, and being able to put together the funds in the needed capital stack.
So you live in Cincinnati. Is there a reason, or what is about the market, the Cincinnati market, that really draws you to it? Is it because of the vicinity and it's so close, basically in your backyard, that you're focused on that market? Are there other factors that drew you to investing exclusively in Cincinnati? I
would say both. So one of our competitive advantages as an investor is our operations and our ability to operate these assets very efficiently, which ultimately forces their value up and also then our operating returns up. And so this being our backyard, being where we're from, having built a construction company here, obviously we have some advantages of this being home, and then we capitalize on those advantages. But looking at it from more of a macroeconomic scale, we like Cincinnati because it produces consistent, predictable cash flow. And so from 2008 to 2018, people were saying Cincinnati, Ohio, or the Midwest is a stagnant area to invest in. Well, as other markets start to shift downward, we're called a stable market now. So it's like, we just don't have huge ups and downs. It's a very consistent, predictable cash flow that's produced here. And that's really what our investment philosophy is. We buy, renovate, force the appreciation, strip the equity, and then we hold for the long term just to produce that consistent, predictable cash flow. But my brother, who's my business partner still, even in the real estate investment firm, his formal education is real estate economics. And so we looked at other markets, but ultimately Cincinnati really matches our investment philosophy. And so it has Fortune 500 companies, a diverse economic base, population growth, albeit modest, but is growing. And one thing we're really excited about on the macroeconomic side is just its overall affordability with lifestyle balance. So we think we'll continue to see that economic growth based on that fundamental.
So then when you're looking at underwriting in the market, are you looking at like what kind of rent increases do you typically look at over the long-term period hold that you're operating the business for?
Yeah, we've always underwritten for between 2 or 3% increases on income and expenses. And usually if it's 2% on income, it will be 2% on expenses, or by like the same, it will match up. Now, that hasn't been the case over the last 2 years, right? We've been very fortunate, but when we're underwriting, we're still projecting at between 2 and 3%, depending on the specific sub-market and what we believe in that specific sub-market. But yeah, there was deals that we bought that were underwritten at 2% increases that actually achieved 20% increases over the last 2 years. So obviously the market helped us out there.
What kind of asset classes are you looking at in terms of, the location and the property types of apartment buildings that are attractive to you and the company?
I think what's attractive to us is cookie cutter. So like, we don't like unique buildings because, as I said, our operational efficiency is our core competency. And so we like things to be predictable and easy. And if I could buy a 200 unit building that has 2 different floor plans and we can just do the same thing over and over on renovations, that's what we like. How that converts is we look at C to B class multifamily in Cincinnati, Ohio. For us, that's going to be like the median household income is kind of that's for Cincinnati as a whole. Those are the areas that we're looking in. So we're looking to appeal to the masses with a product that appeals to the masses. And so kind of right up the middle on what you would think of products available.
What do you think about the cap rates, and what are some of the cap rates that we're typically seeing in the Cincinnati market in comparison to some of the other cap rates that we're seeing in some of the appreciating markets?
Yeah, I think that's a great question for investors who are buying stabilized assets. And so to directly answer your question, I would say Cincinnati, you're going to see somewhere in that C to B class multifamilies, you're going to see somewhere between a 5 and a 7 cap on a stabilized asset. But in our company, we don't buy that many stabilized assets because really what we're good at is forcing that appreciation through property management or construction. And so the best projects I've bought are negative cap rates, right? So about 12 months ago, I bought a 246 unit foreclosure. 100 of those were vacant. Probably 150 of them were economically vacant. And so this was a negative cap rate. This thing was losing money like crazy when we bought it. But because of our ability to have the assurance to underwrite on what we know we can do to it, and then execute on the renovations and getting it back up and running, it's been a phenomenal opportunity. And so when I get that question from real estate brokers, they say, what cap rate are you targeting? And I say, anything, right? It just depends on the upside.
So for a property, it sounds like for a property like in that situation, the 246 foreclosure one, How do you tackle the financing side of things for a property like that, where it's going to be challenging to get certain debt placed onto it?
Yeah, that one, it was crucial to have the relationships. And so we went to a regional bank. The bank's name is actually First Financial Bank. And we had a long relationship with them and the lender there, that they knew our background in construction and they knew our ability to operate. And so they were willing to underwrite off of our pro forma, because in a foreclosure, there are no financials, right? And if they were, they were going to be bad. And so when we go to them and we say, we think we can renovate these within this time frame at this dollar amount, and these are the rents we can achieve, they were willing to lend to us. And now we had to raise the equity for both the down payment and the renovations, which was a large equity raise, but we took that on.
So for something like that, how do you appeal to your investors and giving them the confidence? I mean, you guys have a long history of that construction background, being able to turn around these types of properties. But what are some of the other things that really give confidence to your investors that as you undertake such a distressed type of property, to be able to turn it around and make a profit?
Mm-hmm. Yeah, I mean, it comes down to trust. The same with the lender. Like the lender or the equity investors have to trust that we're going to be able to execute. Some of the nuanced ways I would answer that is we actually owned the next door property. And so we had done something similar right next door. So kind of a track record of success right there, but it wasn't as highly distressed as this one. On that deal, I'm not 100% sure on this, but I think it was 90% or more of our investors were repeat investors. And so it does take that like a time and relationship building to say, hey, you saw us do this on this other property. You've had great results. But at the end of the day, investors are looking for not only return, but risk adjusted return. And so a good way to appeal to investors and get them on board is if there is the ifs, the ands, and the maybes in the narrative of the investment story, there should be higher returns with it, which we were projecting higher than average returns. And therefore, people were excited about getting in on it. And then we're fortunate to be able to say we were able to realize those returns.
When undertaking a property like that, what does it take to be successful in managing to your budget? Because and bringing up the occupancy level, since you said 100 of them were vacant and 100 of them were also economically vacant. What does it take to be successful in turning around a property like that?
Speed. Yeah. You got to be fast because you're going in bleeding, right? You're basically picking up where someone else died, right? Like they went bankrupt, they lost the property, the whole thing fell apart, and we're like, hey, we'll take that. And so you better be able to change it quickly. And so we have a lot of just a good team in place. We are vertically integrated, meaning our property management team is all in-house. We own that company, but also our construction team is all in-house. And so the speed at which we can renovate is pretty quick. And so we were able to take those 100 units, have them all renovated, leased up, and moved in. I think it was within 8 months. And so we project that out and we say, obviously, you're losing the most money in month 1, a little bit less in month 2, a little bit less in month 3. And then you have your break even point where you say, okay, this is where we'll start to cash flow. But you do everything you can to prepare up front, and then you hit the ground running. Then lots of things go wrong, and you have to be a team that's really good at adjusting and pivoting along the way.
What are some of the strategies that you were able to utilize to get the property leased up so quickly? And you said within 8 months.
I would say the harder part is the renovations. And so if you do a good job at the renovations, a lot of times the product can sell itself. Rental demand is extremely high in our market, especially for C and B class assets. And so if you have a good quality product, the demand is there to backfill it. But finding the labor and the materials and getting that all executed within that time frame on the construction side is pretty challenging. How we do that is just kind of through what we've learned over the past 15 years. Like I said, operational efficiencies and economies of scale. And so we have teams of 4 that are doing these apartment turns. We average 2.5 days per apartment turn, meaning like rip everything out, put everything back in, cabinets, floors, everything's coming out. We average 2.5 days per apartment, and just tracking all of that information and giving our team every resource they possibly can to be fast in those moving parts.
And then for you, Jered, when you're looking at turning around those apartments and renovating them up, and putting together the business plan for renovation costs and turnover and having to market and lease up those apartments, what kind of contingencies or reserves do you typically like to hold back also on a project like this?
You mean like beyond what we anticipate?
Yes.
Okay. We typically will, like an additional cash reserve or a miscellaneous in there. We'll look at 2 months rent is a lot of times what we'll do, but it's going to depend on the severity of the value add that we have to implement, right? So if it's 100% occupied and we just need to go in and do paint and carpet, that's going to be very different than the foreclosure example that we just talked about. And so it's similar to just weighing the risk. What's the probability that something goes wrong? How much contingency fund do you need? But I would say a good rule of thumb is you take your total, if you were fully occupied, 2 months rent, and put that in a reserve, and you're going to be pretty good. But it also depends on how good you are at underwriting, right? So I hear a lot of stories of like people who take on these construction projects and it's always more, right? Well, it's not for us. We're pretty good at estimating that just because of our background. And so contingency fund is less important if you're very accurate in your underwriting upfront.
One of the things you also mentioned to be able to manage your company efficiently, especially with all the moving parts, and because you're also so vertically integrated with the property management team, the construction team, your overall head operations business side of things as well. How do you effectively manage all the different teams that are actively moving? Because there's so many different moving parts and things have to move at such a high, quick pace. How are you communicating with all the different pieces and the moving team members?
Well, I think a way to reiterate probably what you're saying is people ask me, I think a lot of investors forget that the asset they're buying is supported by an operating business. But one step further, that operating business is supported by the people who are employed by it. And so I don't do all of those things that you're talking about. It's the people that work in our company as our team, right? So I have great team members that I can rely on. And that in itself has been a great experience and a learning experience and a huge part of building a business. The way as CEO, the way I now communicate with our team, we now have 40 employees, what I do is I'll create visions for what our company is going to look like, feel like, act like, interact with others like in the future. And so I'm writing it as if it's present day. I'll pass that out to my team. And then I say, hey, look, I'm empowering you to reverse engineer and build this, but I trust you to build this within your core responsibilities in your department. So we'll have project managers that are overseeing the construction side, director of construction. Then we have on the property management side, regional manager, property manager, those types of things. But you have to have those people implementing the day-to-day of it.
Yes, especially in real estate and multifamily, we hear it so often that it's a team sport. And the stronger your team is, the further and faster you're able to move. So as you're looking for those team members to come on and to support your vision and your goals, what are some of the things that have made you successful in choosing those right types of partners and people to come join your team?
Yeah, I'm still learning on it, but we have gotten a lot better at it. And so one thing I do is I make sure there's a ton of clarity up front, that our organization has really high expectations, but not just saying that, actually laying out what that means. And so what we do is for every role, we don't just type a job description. We actually give them the performance review up front in the interview. And we say, here's your core responsibilities, 1, 2, 3, 4, 5, and list them out. And here's how you can meet the expectation, exceed the expectation, or fall short of the expectation of that core responsibility. So we break all of that out and we say, if you say yes to this role, this is what you're saying yes to. And then that same document comes out at the 90-day review and the 1-year review. And so clarity up front from our end to the people who are joining the team that we are a high performing team. We have these high expectations. And then during the interview, we have a very strict outline of half of it is about your competency. Can you do the job in those core responsibilities? But the other half of the questions are all catered to values alignment. So we're not a huge fan of the term cultural alignment, because I don't want a bunch of people that are just like me. I just want values alignment. So things like driven, reliable, team-oriented, continuously improving. And so we ask a lot of questions. They're almost like a personality test to uncover, does this person align with the values of our company, with their personal values? And a lot of times our hires are made off of that.
And Jered, where do you see the Cincinnati market heading towards in the future? And what is your company focused on coming up here?
Like I said, it's just a humming right along, kind of that 2% growth year over year and as population growth. And so I see more of what has already come in Cincinnati. And in a time where we look at the Southeast or the coastal markets and their rents are declining and property values are decreasing, this is when the Midwest and specifically Cincinnati, Ohio really shines, right? We don't have those huge ups, but we also don't have those huge downs. And so as I look out at the horizon, I anticipate more consistent, predictable cash flow. And we'll just do our best to continue to uncover those opportunities and invest in them when they make sense.
And Jered, how has real estate investing impacted your life?
Oh, I think any entrepreneur knows there's not a great defined line between personal life and business. I've been doing this since I was 18 years old, and so it's just like a part of me. But I would say in every way possible, right? It not only makes me a better business leader, but now having kids and being married, and I'm better because of what real estate and property management and construction and all of the lessons of building a team and coaching people and pouring into them and giving a part of myself to something bigger than myself. All of those lessons translate both from personal life and professional life. So it's been part of me is the best way I can describe it.
What is the one thing that you know now about real estate that you wish you knew when you first started?
Oh, well, I think wisdom is great, right? But if I knew everything that I know now when I started, I don't think the end of the story would be the same. And so I wouldn't change anything, but something I know now is the value of the team and the people, right? That it started out almost as solo entrepreneurs. And so everything was myself or my brothers back trying to get it done, and how important others are because they oftentimes can do it much better than you.
And what is the one thing that sets successful people apart in real estate investing?
I think it's utilizing what you are good at as an individual. So I don't think there is one thing, the one silver bullet, but for myself and my brother, it was our skill set in construction. So we leveraged that. But for someone else, it might be their background in accounting, that they can leverage that, or it might be their people skills or sales skills or something like that. I would say the important thing is knowing what you're good at and what you'll be able to do for a long period of time, because real estate is a very long game. For a very long time, I didn't make any money. It was all just going right back into the company. So you have to be able to lean on that core competency, figure out what it is, and then lean on it. So that way you can, play that very long game of real estate investment.
And so, Jered, where can our listeners find out more about you?
The best place is going to be our website. It's snscapitalgroup.com. So it's 3 letters like Sam, Nancy, Sam, capitalgroup.com.
Jered, thank you so much for being here today. I really appreciate all of this. This was a fantastic interview. Thank you so much.
Yeah, I appreciate you having me, and hopefully I was able to add value to the listeners.
Absolutely. Thank you.
And thank you for listening to our podcast today, brought to you by Bonavest Capital.
We would really appreciate it if you can go to iTunes right now and leave a rating and written review. Also, please don't forget to subscribe so you can always get the latest episodes. You can also connect with us on Facebook, How Did They Do It Real Estate. We'd love to hear your feedback and any topics that you're interested in for future episodes. Lastly, to learn more about us, you can go to bonavestcapital.com and fill out the Contact Us page so you can speak to us directly. Nothing on the show should be considered as specific personal advice. Please consult your legal, tax, and real estate professionals for individualized advice.